Hello guys, welcome back to my channel. If this is your first time visiting this channel, welcome. And my name is Oler and I'm your personal finance fitness plug, and basically all I do on this channel is explain finance and economics in simple English. Today we'll be completing our series on the questions to ask when you are investing in equities. So when we're investing in equity, we're basically investing in ownership stake in an entity. What that ownership stake gives you is, one, a right to vote, meaning that if any decisions are being made about the company, you have a say, if you get what I mean. So you get voting rights. Another thing that you get is you get an opportunity to share in the profit, if there is any, and that is called dividend. So the nature of equity is that there is no maturity date, meaning that the only way you can exit it is by selling, right? And that is very important, because whenever you're considering equity, the most important thing is, will I be able to sell it? Will someone see this investment opportunity and see it valuable enough to exchange ownership for cash? That is the most important thing. So there are two types of equity investments. There's public equity, where the company is listed on the exchange and you can just buy. You don't need to have a direct relationship with the owners or the executive management of the company. You can buy the stock of the company on the exchange. So there's also private equity, where for you to get an ownership stake in that entity, you must actually come in contact with the owners or the individuals running the business. Of course, both of them have different questions that need to be asked, because they are on different spectrums in terms of risk. For public equity, what you consider is, where do you think this company is going to? Is this company growing? I find that a lot of people consider equity investment retrospectively. What that means is that they look at what the company has done in the past and decide, okay, I want to buy into this company. It's valid to an extent, because if the company has been growing over a period, on a normal day with the same management, it is easy for you to expect that the company will keep growing. However, the fundamental question is, does the company have capacity to grow? Is there still room for the company to grow? Because what you're investing in is not in the past, but in the future of the company. So the next question is, how does the stock perform in the market? So why it is important to know how a stock performs is that there are some companies that are good companies but don't perform well on the exchange, meaning that you can buy the stock at 20 naira, right? And you can come back in 10 years time and the value of the stock is 20 naira 50 kobo, no movement. And then their dividend payments poor, because they don't have a very good dividend policy. When the company doesn't really pay dividends, it's not necessarily bad. It could actually mean that they are putting that capital back in for the business to grow. However, for you as the investor, the reason why you are buying is so that the value can increase. So if the company and the management are making decisions that are not necessarily increasing the value of your investment, then even though the company is good, it might not be a good stock to invest in. Hope that was clear. Then the third thing is the performance of the market. There are times when, for whatever reason, the equity market is down. Now, you might have some companies that are viable, that are doing very well, but because there is something called a risk off is when everybody's selling all their risk. So they don't want to hold any investments. They want all their money in cash, right? Now, in such a scenario, whether or not the company is viable, the shares of that company is going to go down. So there's also that part of timing of the market. If there are any indications that the market might be going south, meaning that things are going to turn red very soon, people are going to start selling, then even though you are a long-term investor with a public equity holding, you could actually sell and wait to enter back to those same stocks at a lower rate, because the company is still thriving, right? And so I know the next question is, okay, so how do I predict the market? Well, that's why you should subscribe to my channel, so that I'll be giving you step-by-step understanding of how the economy works, right? The truth about it is not hard. It's actually not rocket science. It's something that if once you're given like the scope, you can actually figure it out. It's like basic arithmetic kind of understanding. Unfortunately, we find that a lot of asset managers and research people make it sound so grand that most people switch off, but that's what I'm here for, to explain finance and economics in simple English. It means the three things that you consider: is the company performing? Are you expecting the company to grow in the future? How does the stock of that company perform on the exchange? And then how is the general expectation of performance of the market? Now let's go to private entity. Now, the thing about private equity is that it is so varied. There are all sorts of businesses in that space. So you can be talking to a startup, and then you can also be talking to an already established company that is just not listed. It's a little more technical, but then it's still logical. But the fundamental question is, will the value of my investment go up? So first of all, when it comes to private equity, the numbers must be written down. It's not, once someone is selling something to you from the top of his head, it is simply an idea. You need to see the numbers, and before you look at the Excel sheet and get spooked out by it, the basic assumptions, that's what you look out for. What are they as? What are you assuming? You want to sell clothes. How many clothes can you make in a day? And you have 5 working days. It means that you can make 50 a week, and if you do that for a month, it means you can make 200 outfits in a month. How much do you want to sell each outfit? That will tell you your revenue. And is it possible for you to sell all 200 in a month? What is your plan for selling? Now, in all this, when it comes to private equity, the leadership of the organization is key, because no matter how viable a business is, some people could turn the business into a cash cow to fund their personal lifestyles. The next thing you have to consider is, what are the terms? What are they really offering you for the money you are parting with, right? Because you're going to be there for a long while. What you're expecting must be clear. Your stake, the rights you earn, your dividend policy, all those things must be clearly stated, or else it enters into murky waters. Because for every private equity investment where there's little regulation, it's tougher to get a grip on the individual once you've parted with cash. It is fundamentally a trust game, and it is very important to have a lawyer look at the agreement before you even draw down, meaning that before you invest in it. If you notice, I'm not giving you a checklist of 1, 2, 3 things, because private equity is so varied. But the first thing is that whatever the business is created to do, you need to have a market. It needs to be able to sell to people. It needs to be identify who those people are and actually believe that they'll be willing to buy that product. That is very key. Usually private equity offers higher return because of course it's higher risk. And where do you find them? In your environment. Interact with people, be open. When people have good business ideas near you, ask them if you can invest, right? You have that conversation, and you never really know what can come out of it, but you need your lawyer. Like, I will not joke with the need for a lawyer when you go into private equity, because there are so many terms: a business lawyer, a contract lawyer, to make sure that everything is properly documented. It is very, very important. So how do you decide on which one? You are looking to invest in equity, but you might need your money 3, 4, 5 years down the line, then I would recommend going for public equity. Whether it's private or public, you have to understand that they must be selling to someone. You must be able to see how this company can sell what they are producing and sell it well, meaning that there will be confirmed demand. Like, you can see how there can be demand for this particular product or service. That's how you actually assess companies, because they must be selling to someone. I trust this was useful. If you have any questions, please do not hesitate in any way, shape or form to ask me in the comment section. And also do not forget to subscribe to my channel and hit the notification button so that you know when next I have something for you. And don't forget that there are 2 things you must not outsource in this life: your health and your finances. So engage. Bye.